What's up guys, Rosario here. I am an MBA and entrepreneur, and I'm excited to help you learn whether you should rent or buy your property. This is a tough decision that a lot of us have to make. I'm making it right now. I want to walk you through what we're doing to understand whether renting where we currently are or buying a house or condo is going to be a better option for us. There is a way to make this decision in an objective and rational manner that can help you actually grow your wealth and understand which option is going to be best for you to maximize your net worth at the end and have the most happiness as a result. This is a decision that maybe not everyone thinks about. What you might think is, okay, if the mortgage payment is lower than the rent, I should probably buy because I'm going to be building home equity. That's kind of what the general consensus is. I'm here to tell you that's absolutely wrong. That's not what you want to do at all. Today, we're going to talk about why renting versus buying is a more complicated decision. I'm going to provide you a tool that you can use and go out, share it with your friends, use it for your family to make your decision on whether you rent or buy. Please keep in mind, I am not providing financial advice, but I do want you to take a look at this, do your own research, understand that there are other tools out there, that there are options available for you to decide. My goal is to help you grow your wealth and provide value to you. All right, before we get started here, guys, I just want to remind you to click the link down in the description below to get your 10 free dollars with Wealthsimple. Get started trading today, earning money and growing your wealth. If you guys like this content, please smash that like button, comment and subscribe to the channel. Share this video with your friends. I want everyone to know how to make decisions. I want everyone to understand that there's more information out there, that you can make good decisions. Renting or buying is not just a random choice. You actually have the opportunity to make your life better, to grow your wealth and live a happier life. With that, I'm really excited, so let's dive in. We're going to compare 3 properties. One is the property I'm living in right now. That's what we're renting. The second one is a very similar property that we could look to buy in downtown Vancouver. And the third is a property, a house actually, in Victoria, which is where my in-laws live. We are looking to move to Victoria to raise a family. It would be super exciting for us to be out there and we'd love it. What I want to let you guys know is obviously this isn't an apples to apples comparison, Vancouver to Victoria. They are very similar markets, so I think this is actually a good comparison. Unfortunately, we are not able to afford a house in Vancouver proper and we want to live close to the coast. So Victoria is a great option for us. Let's dive right in. Okay, here we have our first property, and this is actually the apartment that we're living in right now. It's a rental property in the heart of downtown Vancouver on a very excellent street right in the middle of the city. Obviously, I've got the exact address blurred out just in case we get any creepy stalkers. Just kidding, I trust you guys. Let's take a look. So it's about a 1,400 square foot or 1,322 square foot apartment. Allows pets, very important for us. We've got a dog and a cat. It's 2 bedrooms, 2 bathrooms, and we're paying $3,700 per month in rent for this apartment. Apartment number 2. This is the buy option for Vancouver. This is a very similar unit in the exact same building. We're looking at an asking price of $1.528 million. And it's actually slightly smaller than the place that we're renting right now. 1,145 square feet, 2 beds, 2 baths, very similar property, slightly lower floor than what we're living in right now, but that's okay. The final property, and the one that I'm most excited about, is this house in Victoria. It's $1.1 million, and that's Canadian dollars, so you can do the conversion if you're American. We're looking at 3,485 square feet, 6 beds, 4 baths, and there's a suite downstairs. I don't know if we can actually say it's a suite, but there are 3 beds, 2 baths downstairs that we could potentially rent out. To do our calculations, what we need to figure out is what's the best option here, and this involves something called opportunity cost. Everything you do has an opportunity cost, and what that opportunity cost is what you are giving up by choosing that option. When you buy a house, the opportunity cost of purchasing a house is the cost of the down payment that you could have taken and invested into the market. You're also giving up the costs of your interest payments. So that can also be factored into your opportunity costs. In the case of renting, what you're giving up by renting is the opportunity to build equity and grow your wealth by owning a home. So what we're going to cover in this video is the difference between the opportunity cost of buying and renting, which is going to be worth more to you in the end. We're going to do an example of buying versus renting after 10 years, assuming you're going to sell your property after 10 years. And we're going to take a look at what the outcome is in terms of actual how much net worth you have at the end of those 10 years with either option. In order to do this opportunity cost comparison, we're going to need to use a few formulas. So I've put together an Excel spreadsheet with the help of a mortgage broker and my finance background and my understanding of the real estate market in Canada and throughout the world. So please take a look. I've actually left a link to this spreadsheet right in the description below. You can head down there right now, take a look at it. You can try these calculations out for yourself, see what you come out with, try to understand that different situations can apply in different areas. So make sure you look up the different laws for property taxes, for different fees and taxes that might be included in different parts of the province. And if you're watching this in the States, different factors may apply, like different minimum down payments. One of the things that you'll notice is that we have to put 20% down on this purchase. The reason for that is that Canada requires 20% down payment for any property over $1 million. The numbers would actually work out a lot more in our favor if we didn't have to put down 20%, but unfortunately, that's the way the market is today. So let's take a look. Let's dive right into the spreadsheet and see what we come up with. Okay, so on the screen here, we have our rent option, and this is the property in downtown Vancouver. It's over the 30th floor, 2 beds, 2 baths. It's perfect for our family, which is myself, my wife, and our 2 pets, Lawrence, the dog, and Tom the cat. So we've got 1,322 square feet, as mentioned before. We've got a 12-month lease that's renewable after that period expires. And our recurring costs are our rent, our utilities, and our renter insurance, which come out to $3,945 per month. That's what we have to pay out of pocket every single month in order to live here. That does sound like a lot. That's what the market goes for in Vancouver for a 2-bed, 2-bath. Unfortunately, to be able to live in this city, that's what it costs. We do have some upfront costs as well with renting, and that's basically our damage deposit and the pet fee. That's $4,000. We've got that $3,945 a month. That's going to increase with inflation every year. In Vancouver, rent prices tend to go up anywhere between 2 and 4% every year. So we've used an average of 3%. And what that means is that every single year, our landlord is going to come to us and say, hey, you need to pay 2% more for this property to rent this property and to keep living here. So we're going to have to take that into account in our calculations, and we do that a bit later on. Now that we've talked about the cost of renting a condo, what we now need to find out is how much would it cost to buy that same condo, and what would the payments look like? Because in order to do an opportunity cost calculation, we need to know what our other opportunity is. So if we have option A, which is renting, we need to have option B, which is purchasing in a similarly priced location to kind of compare the two and give an understanding. Let's take a look here at the second property in our list, which was the $1.528 million condo in the exact same building that we're renting today. We're looking at property taxes of $4,024 per year, maintenance and strata fees of $532 per month. For all you people from outside of BC, a strata is essentially a condo association. Whenever I say the word strata, just think condo board. Let's take a look here. There's also a tax in BC called the Provincial Land Transfer Tax. It's going to be $28,560. We're looking at lawyer fees, so you need to involve a lawyer when you purchase a house. This comes out to about $1,000. There's title insurance of $493, a home inspection of $500, an appraisal of $300. And As mentioned before, it's slightly smaller at 1,145 square feet. So in our buy decision, we're going to take a look at a 30-year mortgage because that's going to give us our best options here in terms of lowest payment amount. So at an interest rate of 2.79%, we're going to be paying $5,000 per month towards our mortgage. What you need to understand is that when you're paying down your mortgage, there's actually a couple components that you're paying. Your payment remains fixed throughout those 30 years. You're going to be paying $5,006 a month. But as you start out, you're actually paying a higher share of interest and a lower share of principal. As you go further and further along in your mortgage, you're paying down the principal more and more. The amount that you're paying to them in terms of interest reduces over time. Now, as I mentioned before, we have 20% down. And with that 20% down, we are then mortgaging $1.22 million. That is the amount that we're paying that 2.79% interest on initially. As mentioned, we've got our principal plus interest blended payment of $5,000 per month. We've got utilities of $200 per month, which I assume to be the same as renting. We've got home insurance of $100 per month, which will increase with inflation. We've got property taxes of $337 per month, which will also increase with inflation, and strata and condo fees of $532 per month. We've left repair and maintenance costs fairly low because this is a condo. There's not a whole lot to do. We're looking at a total monthly payment of $6,224 per month, which is significantly higher than what we pay to rent here. On its face, doesn't look like a great option. We have to pay a whole bunch down, and then we have to pay a higher rate monthly to live here. But remember, we are building that equity. There is kind of that deeper value being created here. So let's try to understand and do that opportunity cost comparison. To do that, what we need to know is how much we're giving up in that upfront cost of buying compared to renting. When we buy, we have to put down that $300,000+ in this case in order to lock down that house, and that money is locked up. We can't do anything with it. In the case of renting, what we're able to do is we're actually able to take that $300,000 that we would have put down on the house and invest it into the market and grow our wealth that way. What we need to do to understand the opportunity cost is calculate what that upfront cost is, and then we can look at the opportunity cost as compared to renting. So we know that the down payment amount will be $305,000, which is 20% of the purchase price, plus the taxes, etc. So we've got the provincial land transfer tax, legal fees, title insurance, home inspection, and appraisal for a total of $336,453. So that is the amount that we have to take out of the bank, put it right into our property. We don't have access to that money. Obviously, we retain some of it as home equity. In the case of renting, we'd be able to take all that money, invest it into the market or invest it into another asset and grow our wealth that way. Now, what we need to figure out is how much of our payment is actually going into growing the equity of the house, because at the end of those 10 years that we spoke about before, we can actually sell the house and get some of that money back. Our total mortgage payments after 10 years, basically just 12 times that $5,000 per month times 10, are going to be $600,000 in 10 years. So we will have paid $600,000. And remember, that's a combination of your principal and your interest payments. So we've got a total interest cost, and you can calculate that using a simple formula in Excel. It's the QMI payment formula, and we've calculated that to be about $300,000 calculated at the end of the period. $301,000 of our mortgage paid down after 10 years. That means including our principal of $300,000 that we paid upfront, we have home equity after 10 years of $606,705. This is where this calculation gets a little speculative. What you have to understand is I don't know how much real estate is going to appreciate in the future. No one does. If you ask anyone and they tell you exactly what real estate is going to appreciate in the next 10 years, they're either lying or they're Nostradamus. But what I'd like you to know is that we can look at historical averages. We know that the historical average return, the nominal return, so the return before inflation, is about 3.5%. After 10 years, we can expect to sell this property that we purchased for about $1.55 million for $2.155 million. Obviously, this depends on the appreciation of houses continuing over the foreseeable future. But we have seen this happen in the past. Unless you see a huge market crash coming or a crash in the demand for housing, this is probably going to continue into the future. So we can look at our price of $2.155 million that we should be able to sell our condo for in about 10 years. Then we still have our remaining principal owing on our mortgage of $921,000. So we have to subtract out that remaining principal to get our total assets at the end. So our total assets that we'll have after 10 years before selling costs are $1.234 million. Just by purchasing this house, putting money towards the equity in the home, we'll have built our wealth by $1.234 million in 10 years. If we want to actually access that money, we're going to have to sell this property. So then we get into these selling costs. So we've got our real estate commission, which is about $58,000 or 2.5%. We're looking at GST as well of about $3,000. So that means as the seller, we're going to receive about $2.094 million. Your net assets after the sale of your home are going to be $1.17 million. Now in Canada, on the sale of your primary residence, you don't have to pay capital gains tax. What that means, okay, I'm selling my house after 10 years. Normally what the government would do is they'd say, okay, your house appreciated from, let's say, $500,000 to $1 million. You would have to pay tax on that additional $500,000 that you made. So you'd have to pay a 20% tax on that. So you'd have to pay $100,000 in tax because your property appreciated from $500,000 to $1 million. But the government, because they're so nice, just kidding, the government allows you to deduct your capital gains tax for your primary residence. The reason for this might be because when you're selling your primary residence, you probably have to buy another primary residence. And if the appreciation that happened on your property happened everywhere else, you're going to need that money to be able to take over and purchase your next house. Regardless of the reason, what we're left with at the end is going to be actually tax-free money that we can invest into other things or purchasing a new home. After selling costs, after 10 years, we can expect to have in the bank $1.17 million. All right, well, that's great, but we didn't look at what we could have in the bank if we actually rented. So let's go over to the other side of the spreadsheet and find out, let's say we didn't have to put down that $300,000 to buy initially for the down payment. We could put that in the bank and then invest the difference between the rent and how much we have to pay monthly for the mortgage, which we know was over the amount that we were paying for rent, and put those both in the bank and see what happens. So here we have the rent side of the opportunity cost equation. From our previous calculation, when we buy, we have to put down $330,000 up front. When we rent, we don't have to put that money down, but what we can do is actually take that money that we would have used to buy and we can actually invest it. And we can invest it in the market. What that means is that we can take that principal, that $330,000, and we can put it in an S&P 500 index fund using Wealthsimple or Quest Trade, or we can put it into our RSPs, or we can deposit it, take some of that, put it in our TFSA, and grow that through investing in different funds. If you look at the historical returns for the S&P 500, which is the major stock index of the United States, the top 500 largest companies, we have an average of 8% over the last 50 years. That means if you take that $332,000 and you put it into the market, on average, you're going to grow that by 8% per year compounded, and you'll have that much in return. So that's kind of like a safe bet in terms of nominal growth of your money. Obviously, inflation will erode some of your spending power, but we're going to do the nominal kind of future value calculation here. We also have an additional $2,279 that we can also invest because our rent is lower than our mortgage plus our cost of ownership in the example of buying. So we've got $2,279 that we can also invest in the market. I just want to remind you guys that all of these calculations break down if you take that extra money and you just blow it on Apple products. What I'm saying here is that you have to take every dollar that you would have spent buying your house and actually put that into actual investments that can grow over time. specifically the market. If you think you can get a better than 8% interest rate on your money, sure, go ahead and do that. Put in the calculation, you'll find out what you can get here. Next, what I want to draw your attention to is this annual rent increase. So that is the inflation rate, or the amount that rent increases per year, and the average in Vancouver is between 2 and 4%. The government has actually used to cap it at 4% per year. So that's the max amount your landlord could raise your rent every single year. Recently, they've set it to 1.4%, but I think that number will go back up in the future. So we've set it to 3% as an average for the next 10 years. Let's figure out how much money we'd have in the bank after 10 years if we're taking all that money that we would have spent on the mortgage and investing it in the market. Our future value of the principal, so taking that $332,000 and popping it into the market, after 10 years would be $717,000. So $332,000 invested at 8% per year. For the next 10 years, after 10 years, you'll have $717,000 in the bank. With your payments, so the difference in the amount between the mortgage and the rent, $415,000. That's also taking into account increases in the price of rent because of inflation. After 10 years, we're gonna have total assets in the bank of $1.132 million. So that's actually quite comparable to the buy decision. They're actually almost identical. It's kind of a toss-up between whether you should rent or buy. However, the key point here is that when you actually sell all these stocks, or you sell your S&P 500 shares, after 10 years, you're gonna have to pay capital gains tax on the value that they increased by. After those 10 years, you're gonna have $283,000 owing in capital gains tax, which means that your net assets after tax are going to be only $850,000. That's really where buying a house starts to make a lot of sense. If you have to pay capital gains tax on your invested assets when you withdraw them, you're losing out on a lot of potential gains in assets. So at this point, I'm thinking, wow, maybe it really does make sense to buy. There are some downsides to living in Vancouver. I don't know if we want to live here for 10 years. We want to start a family. We want to have kids. So what we did is we took this to the next level and we looked at an option in Victoria. Let's do that comparison now compared to renting and see what we come out with. Okay, guys, so here we have that property in Victoria. I'll just let you guys take another quick look at it so you know what it looks like. It's a house. It's got 6 bedrooms, 4 bathrooms. It's listed for $1.1 million, and this is in Victoria. I want to let you guys know that obviously there are different job opportunities, different costs of living in other areas in Victoria compared to Vancouver, so you also have to take those into account. Right now, we're just looking at that pure rent versus buy decision. In your case, those other costs may vary, and you're going to have to take those into account as well. We'll probably cover that in a future video, so please subscribe to the channel. You will get that information as it comes in. So we're looking at $1.1 million purchase price, $4,494 per year in property taxes, so actually slightly higher property taxes compared to the condo. Vancouver actually has Canada's lowest property tax rate, so Victoria's are a little bit higher. Don't have any maintenance and strata fees because this is a house and not a condo. We've got the transfer tax of $20,000. Lawyer fees of $1,000, title insurance $493, home inspection $500, appraisal $300, and a square footage of 3,485. Significantly larger than the condo that we're living in right now. Looking at the same amortization period of 30 years and a 2.79% interest rate, which is what we can get, we're looking at a monthly payment of $3,604. That's actually a lower monthly payment than what we're paying right now in rent. Part of that is actually going towards building our equity, so that's a good thing. We're looking at 20% down, so the amount mortgaged is $880,000. Our mortgage payment is the principal plus the interest blended payment, which is $3,600 per month. Utilities are $200 per month. Home insurance, $100 a month. Property taxes, $374 a month. No condo fees, but we've included maintenance and repairs for a total of $4,878 per month. Let's take a look at our upfront cash costs. So our down payment amount is only $220,000 this time instead of over $300,000. We're looking at that provincial land tax, legal fees, title insurance, home inspection, and appraisal. So we have an all-in cost of $242,000. That's a lot lower than purchasing the condo. It's It's a lot more space. Obviously, it's in another city, so there's some differences there. But upfront, this is a lot less money that we have to put down. After 10 years, we'll have paid a total of $432,000 toward our mortgage. We'll have paid $215,000 in interest, and $216,000 will have gone towards paying down our mortgage. By that point, we will have built up a home equity of $436,764. Our mortgage paid down plus our initial down payment towards the house. With our expected housing return of 3.5%, we use the same number because that's a global average. Markets can change and fluctuate over time. Victoria and Vancouver have seen much higher rates than that in the past, but I wanted to be conservative. After those 10 years, we arrive at a house value of $1.551 million. That means in 10 years, we could probably sell this house for about $1.55 million. The remaining principal owing on our mortgage would still be $663,000. So our total assets would be $888,423. After our selling costs and real estate commission, we'd receive $1.56 million, and we'd have a net asset after the sale of $842,000. In the previous example, we had $1.172 million. When you look at it, you have more money living in the condo after those 10 years because the appreciation on that higher price puts you at an even higher price after 10 years. That doesn't seem so great. Also, looking at our rent in the other situation, we'd have $850,000 after tax. In this case, we'd only have $842,000. But we need to compare apples to apples. We need to compare renting versus buying in Victoria. So we're not actually looking at what if we had bought in Victoria. We're looking at, okay, what if we had continued renting in Vancouver? So we have to change some of our numbers here. So obviously we're assuming the rental costs are going to be the same. We're going to spend 10 years, but then our cash available to invest is actually going to be lower in this situation because we're only having to put $240,000 down. Our monthly cash to invest is now $933 because the difference between our rent rate and our mortgage plus our costs is lower. So we've got our annual rent increase rate of 3%. That leaves us with a future value of our principal of $514,000 and a future value of our payments. So our monthly payments, the difference in the monthly payments that we're putting into the market of $170,000. So the total assets would be $684,000 less a capital gains tax of $171,000. Leaves us with just over $500,000 in assets. Now that we look at this, when we compare these two options, what we're finding out is that after 10 years in Victoria, we're actually significantly better off than we would be had we continued to rent in Vancouver. It looks like buying in Vancouver might actually be the best decision in terms of amount of assets in the end. However, that really depends on where you want to live. Do we want to live in a condo for the next 10 years? We can't say to ourselves, in all honesty, that we want to live in a condo. Guys, where does that leave us? Where does that leave us after the end of this video? Do you want to rent or do you want to buy? The answer is more complicated than one or the other. What you need to do is figure out the opportunity cost. Understand what's important to you and where you want to be in the next years of your life. I've left a link to this very spreadsheet in the description below. So please click on it. Check out what you're renting now, check out a place that you could buy or that you own right now, and do a comparison for yourself. Try to understand what your personal situation is and what your costs and opportunities are. If you understand your opportunity cost, then when you go to make a decision, it's not just a fluff choice. You're actually picking between real numbers and knowing this option will make us better off after 10 years compared to this other option. From this calculation, we understand that buying could be a better decision for us after 10 years compared to renting. That might not be the same for you. It depends on local market conditions and what you can expect to earn by investing your money in the market. I want to heavily emphasize this. If you are not taking the difference in the amount and investing it into the market, you will not be better off renting. If you don't have that discipline to take that money that you would have put towards your mortgage and invest that into the market, maybe the best option for you would be to buy, because then you're guaranteed to have to put that money towards your mortgage. I do want to identify that there are some risks with owning. You're going to have to continually pay down your mortgage. So if you lose your job and you're not able to make your mortgage payments, then you could lose your house, and that is a risk. You do also have to take into account risks when you're making these decisions. But for the most part, this spreadsheet will give you a good idea of if you should rent or if you should buy in your particular circumstance. Thank you so much for watching, guys. I hope you enjoyed the video and that it provided just a little bit of value to you. If you think it did, please share it so we can continue to grow the channel and so that I can continue to make other videos like this. If you enjoyed, please like, comment, and subscribe. And for now, we'll see you in the next one.